Question 1. Which of the following is not a characteristic of an insurable risk? A. The risk is predictable and can be statistically measured. B. The risk is based on a large number of similar exposures. C. The risk results from intentional actions or fraudulent behavior. D. The risk must be financially feasible to insure. Answer. C. Explanation. An insurable risk must not be the result of intentional actions or fraudulent behavior, or risks arising from intentional acts or fraud are typically uninsurable, as they are deemed to lack randomness and may result in moral hazard. An insurable risk should be unpredictable, and it must be based on large numbers of exposures that statistically allow the risk to be managed. Options A, B, and D are characteristics of an insurable risk because they align with actuarial methods of predicting risk and the feasibility of underwriting it. Question 2. Scenario question. Mr. Lewis has been issued a life insurance policy that includes an accidental death rider. He was recently injured in an accident and passed away from the injuries. Is beneficiary to MS. Spencer files a claim under the accidental death rider. What must the insurance company determine before paying out the claim? A. Whether Mr. Lewis was involved in an intentional act. B. Whether Mr. Lewis missed premium payments in the last year. C. Whether Mr. Lewis was diagnosed with a pre-existing condition before purchasing the policy. D. Whether the cause of death meets the terms of the accidental death rider. Answer. D. Explanation. The insurance company must determine whether the cause of death meets the terms of the accidental death rider. These riders provide additional coverage in case of death caused by accidents, and the cause of death must align with the definition of an accident in the rider's provisions. If the death was due to an intentional act or conditions excluded under the rider, the claim would likely be denied. Options A, B, and C do not pertain directly to the rider's terms, as they address other policy aspects that do not influence the payout of the accidental death benefit. Question 3. Which of the following is the common exclusion in most property insurance policies? A. Theft. B. Earthquake damage. C. Vandalism. D. Fire damage. Answer. B. Explanation. Earthquake damage is typically excluded from standard property insurance policies. Many insurers require separate earthquake insurance or endorsements to cover such risks. Theft, vandalism, and fire damage are generally covered under most property insurance policies, assuming the conditions of the policy are met. Earthquake coverage often requires a specific rider due to the significant cost associated with such events and the limited frequency of their occurrence. This is a crucial distinction in understanding the scope of standard property policies and their limitations. Question 4. In South Dakota, which of the following actions by an insurance producer would be considered a breach of fiduciary duty? A. Depositing client premiums into a separate trust account. B. Providing clients with detailed disclosures about policy terms. C. Using client premiums for personal expenses before remitting them to the insurer. D. Following the client's instructions regarding coverage changes. Answer. C. Explanation. Using client premiums for personal expenses is a clear breach of fiduciary duty. Insurance producers are required by South Dakota law to hold client funds in trust and remit them promptly to the insurer. Fiduciary duty mandates that producers act in the best interests of their clients, including safeguarding funds. Options A, B, and D are examples of actions that uphold fiduciary responsibilities, ensuring clients' trust and regulatory compliance. Question 5. Scenario question. MS. Anderson owns a property insurance policy that includes a war exclusion clause. During a period of civil unrest, a group damages her property. She files a claim under her policy. Which of the following factors will the insurer consider to determine whether her claim is valid? A. Whether the damage resulted from an official declaration of war. B. Whether the damage occurred due to vandalism during the unrest. C. Whether the policy includes additional endorsements for political risks. D. Whether MS. Anderson reported the claim within 30 days of the incident. Answer A. Explanation. Most property insurance policies include a war exclusion clause that excludes coverage for damages resulting from acts of war. For the exclusion to apply, the damage must be directly linked to a declared war or military action. If the damage resulted from vandalism or civil unrest without a formal war declaration, it may be covered. Options B and C address scenarios that might impact coverage but do not affect the war exclusion. Option D pertains to reporting timelines but does not influence whether the war exclusion applies. Question 6. Which of the following best describes the principle of utmost good faith in insurance contracts? A. The insurer must offer the best possible policy terms to every client. B. The policyholder and the insurer must disclose all material facts honestly. C. The policyholder can modify the terms of the policy at any time. D. The insurer must pay claims even if the policyholder provides false information. Answer: B. Explanation. The principle of utmost good faith requires both the insurer and the policyholder to disclose all material facts honestly and completely. This mutual obligation ensures that both parties have accurate information to enter into a fair contract. Option is incorrect because insurers are not obligated to offer the best possible terms to every client, but must offer fair terms based on risk assessment. Option C is false as policyholders cannot unilaterally modify policy terms. Option D is incorrect because false information provided by the policyholder may lead to claim denial or policy cancellation. Question 7. In South Dakota, which of the following types of insurance is considered mandatory for most employers? A. Professional liability insurance. B. Homeowners insurance. C. Workers' compensation insurance. D. Flood insurance. Answer: C. Explanation. Workers' compensation insurance is mandatory for most employers in South Dakota. It provides coverage for employees who suffer work-related injuries or illnesses. Failure to carry this insurance can result in penalties. Professional liability and flood insurance are optional coverages, while homeowners insurance is only mandatory if required by a mortgage lender. Understanding mandatory coverages is critical for insurance producers when advising clients. Question 8. Which of the following statements about reinsurance is correct? A. Reinsurance eliminates all risk for the primary insurer. B. Facultative reinsurance covers an entire portfolio of policies. C. Treaty reinsurance automatically covers specified risks. D. Reinsurance is only used for catastrophic events. Answer: C. Explanation. Treaty reinsurance is a type of reinsurance agreement in which the reinsurer automatically covers specified risks according to the treaty terms. It provides ongoing coverage for a class of policies without the need for individual risk approval. Option is incorrect because reinsurance does not eliminate all risk but helps manage it. Option B is incorrect as facultative reinsurance applies to individual policies. Option D is incorrect because reinsurance is used for a variety of purposes beyond catastrophic events, including managing risk and ensuring solvency. Question 9. Scenario question. Mr. Bennett recently purchased a homeowner's insurance policy. A few months later, he decided to rent out a portion of his home. After a fire caused significant damage, he filed a claim under his policy. What key factor will the insurer evaluate to determine whether the claim is covered? A. Whether Mr. Bennett disclosed his intention to rent the property when purchasing the policy. B. Whether the fire was caused by a natural disaster or intentional act. C. Whether Mr. Bennett had an umbrella policy in place at the time of the loss. D. Whether the tenants had their own renters insurance policies. Answer: A. Explanation. Homeowners insurance policies are typically written for owner-occupied properties. If Mr. Bennett failed to disclose his intention to rent out a portion of his home, the insurer may argue that the risk profile has changed, potentially leading to claim denial. Option B pertains to the cause of the fire but does not address policy terms related to property use. Option C is unrelated to the homeowner's policy, and Option D concerns tenants' coverage, which is not relevant to the homeowner's policy. Question 10. Which of the following types of property would typically require a specific endorsement to be fully insured under a homeowner's policy? A. Furniture. B. Jewelry. C. Kitchen appliances. D. Landscape. Answer: B. Explanation. High-value items like jewelry often require specific endorsements or scheduled personal property coverage to be fully insured under a homeowner's policy. Standard homeowners' policies have limits on coverage for certain items such as jewelry, furs, and art. Furniture, kitchen appliances, and landscaping are generally covered under standard policy limits without requiring endorsements. Failure to properly endorse valuable items could result in inadequate coverage in the event of a loss. Question 11. Which of the following accurately describes the claims-made liability policy in South Dakota? A. It provides coverage for claims filed only during the policy period, regardless of when the incident occurred. B. It covers claims made at any time, provided the incident occurred during the policy period. C. It requires both the incident and the claim to occur within the policy period. D. It covers incidents that occur before the policy start date as long as the policy is active when the claim is made. Answer: A. Explanation. A claims-made policy provides coverage only if the claim is made during the policy period, regardless of when the covered incident occurred. This differs from an occurrence policy, which covers incidents that happen during the policy period even if claims are made later. Question 12. In South Dakota, how long must insurance companies retain records of insurance transactions to comply with state regulations? A. 2 years. B. 3 years. C. 5 years. D. 7 years. Answer. C. Explanation. South Dakota law requires insurers to retain records of insurance transactions for at least 5 years. This ensures that documentation is available for regulatory reviews and audits. Question 13. Which of the following is considered unfair discrimination under South Dakota insurance law? A. Charging high premiums based on a policyholder's occupation. B. Offering low premiums for customers with good credit scores. C. Refusing to provide coverage due to policyholders' driving history. D. Charging different premiums based on the age and condition of vehicle. Answer A. Explanation. It is considered unfair discrimination to charge different rates based on non-risk-related factors such as occupation, race, religion, or gender. Premiums must be based on risk-related factors that directly affect the likelihood of a claim. Question 14. What is the minimum liability coverage required for bodily injury per accident under South Dakota's auto insurance laws? A. $15,000. B. $25,000. C. $50,000. D. $100,000. Answer. C. Explanation. South Dakota law requires a minimum of $50,000 liability coverage for bodily injury per accident. The minimum coverage for bodily injury per person is $25,000, and for property damage, it is $25,000. Question 15. Which of the following statements about underwriting is true? A. Underwriting determines the claim settlement process. B. Underwriting involves calculating policyholder premiums based solely on credit scores. C. Underwriting is the process of evaluating risk and determining eligibility for coverage. D. Underwriting ensures all applicants receive identical policy terms. Answer. C. Explanation. Underwriting is the process insurers use to evaluate risk and determine whether to offer coverage, what policy terms to apply, and the premium to charge. It considers various risk factors, not just credit scores. Question 16. Scenario question. A South Dakota homeowner files a claim for roof damage after a hailstorm. The insurer offers a lower settlement amount due to the age of the roof. Which policy provision is most likely affecting the settlement amount? A. Replacement cost provision. B. Depreciation clause. C. Inflation protection clause. D. Scheduled personal property endorsement. Answer. B. Explanation. The depreciation clause reduces the claim payout based on the age and condition of the damaged property. If the roof is older, the insurer may reduce the settlement to reflect its depreciated value rather than paying for a full replacement. Question 17. In South Dakota, which of the following insurance practices is prohibited under the Unfair Trade Practices Act? A. Offering promotional gifts to clients. B. Denying a claim based on lack of coverage. C. Refusing to pay a claim without conducting a reasonable investigation. D. Cancelling a policy due to non-payment of premiums. Answer. C. Explanation. The Unfair Trade Practices Act prohibits insurers from denying claims without a reasonable investigation. Insurers must thoroughly investigate claims to ensure fair treatment of policyholders. Question 18. Which of the following best describes coinsurance in a property insurance policy? A. A percentage of the claim amount the insured must pay before coverage applies. B. The total amount of coverage required by law. C. The insured's share of the premium payments. D. Clause requiring the policyholder to insure property to specified percentage of its value. Answer. D. Explanation. Coinsurance requires the policyholder to insure the property to a certain percentage of its value, typically 80% or more, to receive full claim payments. Failure to meet the coinsurance requirement may result in reduced claim payouts. Question 19. Under South Dakota law, how many days' notice must an insurer provide to cancel a homeowner's policy for non-payment of premiums? A. 10 days. B. 15 days. C. 20 days. D. 30 days. Answer A. Explanation. In South Dakota, insurers must provide at least 10 days notice before canceling a homeowner's policy for non-payment of premiums. This allows the policyholder time to make payment and prevent cancellation. Question 20. Which of the following is true about surplus lines insurance in South Dakota? A. Surplus lines insurance is offered by admitted insurers only. B. Surplus lines policies are regulated identically to standard insurance policies. C. Surplus lines insurance covers risks that standard insurers do not typically insure. D. Surplus lines insurers must be licensed by South Dakota. Answer C. Explanation. Surplus lines insurance provides coverage for unique or high-risk situations that standard insurers are unwilling to cover. These insurers do not have to be licensed in the state, but must comply with surplus lines regulations. Question 21. Which of the following is an example of twisting under South Dakota insurance laws? A. An agent persuades a client to cancel their existing policy by making false statements about the benefits of a new policy. B. An insurer denies a claim without a proper investigation. C. An agent fails to disclose policy exclusions to a client. D. An agent offers a lower premium to a client based on their occupation. Answer A. Explanation. Twisting is an illegal practice where an agent misleads a policyholder into replacing their current policy with a new one by providing false or misleading information. This is prohibited to protect consumers from unnecessary policy changes. Question 22. In South Dakota, which of the following would require a surety bond to operate legally? A. A public adjuster. B. A surplus lines broker. C. A life insurance agent. D. A claims examiner. Answer B. An explanation. A surplus lines broker is required to obtain a surety bond to ensure compliance with state laws and regulations. The bond provides a financial guarantee that the broker will act ethically and responsibly. Question 23. Which type of insurance policy would be most appropriate for a business in South Dakota that wants to protect against liability claims arising from product defects? A. Professional liability insurance. B. Commercial general liability CGL insurance. C. Business interruption insurance. D. Workers' compensation insurance. Answer B. Explanation. A commercial general liability CGL policy covers businesses against liability claims related to bodily injury, property damage, and product defects. Question 24. What is the primary purpose of the South Dakota Guarantee Association? A. To regulate insurance rates within the state. B. To provide legal advice to policyholders. C. To ensure that policyholders receive coverage if their insurer becomes insolvent. D. To offer discounted premiums to low-income policyholders. Answer C. Explanation. The South Dakota Guarantee Association protects policyholders by covering claims if their insurance company becomes insolvent. This ensures that policyholders are not left without coverage due to their insurer's financial failure. Question 25. Which of the following would not be considered unfair claim settlement practices in South Dakota? A. Misrepresenting policy provisions to claimants. B. Failing to acknowledge and act on claims promptly. C. Offering to settle a claim for less than the policyholder's coverage limit without justification. D. Denying a claim based on fraud after thorough investigation. Answer D. Explanation. Denying a claim based on fraud after thorough investigation is a legitimate practice. However, misrepresentation, delays, and lowball settlements are considered unfair practices. Question 26. Scenario question. A South Dakota policyholder files a claim for water damage caused by a burst pipe. The insurer denies the claim, stating the policy does not cover flood damage. What should the policyholder do next? A. Accept the denial and close the claim. B. File a complaint with the South Dakota Division of Insurance. C. Hire a public adjuster to negotiate the claim. D. Request clarification on whether the damage is classified as flooding or another covered peril. Answer D. Explanation. The policyholder should first seek clarification on whether the damage is classified as flooding or another covered peril, such as water damage from a burst pipe. Many policies distinguish between these types of water damage. Question 27. Under South Dakota law, how many days' notice must an insurer give before non-renewing a commercial insurance policy? A. 10 days. B. 30 days. C. 45 days. D. 60 days. Answer See explanation. In South Dakota, insurers must provide at least 45 days notice before non-renewing a commercial insurance policy. This gives businesses time to secure alternative coverage. Question 20. Which of the following best describes the concept of subrogation in insurance? A. An insurer's right to deny claim if premiums are not paid. B. An insurer's right to pursue third party responsible for loss after paying claim. C. Policyholder's obligation to notify the insurer of loss within specific time frame. D. Policyholder's right to appeal denied claim. Answer B. Explanation. Subrogation allows an insurer to recover costs by pursuing a third party responsible for causing the loss. This prevents the policyholder from profiting from both a claim payment and compensation from a third party. Question 29. Which of the following is considered rebidding under South Dakota insurance law? A. An agent offering to reduce the premium for a policyholder's loyalty. B. An agent providing promotional pen with the company logo. C. An insurer offering discounts for bundling multiple policies. D. An agent charging different commissions for different clients. Answer A. Explanation. Rebating is offering something of value such as a premium reduction to a policyholder as an incentive to purchase a policy. It is prohibited to ensure fair competition and ethical practices. Question 30. In South Dakota, what is the penalty for an agent who knowingly makes false statements in an insurance application? A. A fine of up to $500. B. License suspension or revocation. C. Mandatory ethics training. D. A written warning. Answer B. Explanation. Knowingly making false statements in an insurance application is a serious offense that can result in license suspension or revocation. Ethical conduct is essential in the insurance industry to protect consumers and maintain trust.